Okay, let's do our Q&A for the previous Sunday's market outlook. YouTube has recently introduced a new feature, at least it seems new to me, otherwise I've just never seen it before, but it allows me to identify questions from subscribers versus non-subscribers. And since the number of questions seems to be increasing every week, I'm going to start prioritizing all the subscriber questions first, and then if I run out of time, then I run out of time. So if you do have questions and you want your question answered, you will have to subscribe. I do have to find a way to limit it. So I'll answer as many as I can this week, but starting next week, I will prioritize it based on who's got the little red button beside their comment. At least in YouTube Studio, I can see the red icon. Okay, first one. I fully understand and agree with your observation that there might be, for now, unless CPI continues to accelerate, the last month of heightened volatility where it's profitable to aggressively sell calls on upside days and puts on downside days. That being said, I was hoping that you could share your thoughts on what shelter accounts, I'm not sure what a shelter account is, could have done in the last few months to emulate a strategy similar to yours, like 50,000. Maybe you mean smaller accounts. It would be completely irresponsible to trade options on SPY unless you have a sizable account. Yeah, you can use anything that is a diversified ETF. You can even use just a particular sector if you're familiar with its correlation with SPY and its beta. For a small account, a nice safe one to use would be the XLP, which is consumer staples. Nice one to use. The options aren't going to be as rich as they are on SPY, but as far as training wheels are concerned, starting with something that has lower volatility, lower premiums, just to get a feel for it. And then if you really want to move to something exciting, you can move to the XLY, which is consumer discretionary. If S&P does this, consumer discretionary does this, right? SPY is $380, XLY is about $150, so it's much lower priced. XLP is about 72. Now you don't have to use those. You can find any ETF that has a high correlation with SPY. Just be very comfortable with the technical and the fundamental levels on that chart, and make sure that when you're selling your calls and you're selling your puts, you're finding the right levels to sell them at. You can't just pick one out of thin air. After a while, after years of doing this, you just get a feel for where the price is. You get a feel for how fast the price is moving, and you can sort of almost see the levels on the screen without actually having to draw anything out. But when you're just beginning, be aware of what the primary trend is. Be aware of where the technical levels are, not because you believe them, but because a lot of other people believe them, and they will meet resistance at those places. When you have a rally, you have to sort of anticipate, well, does this rally have legs for a while? Is this a 1 or 2 day rally, or can this continue for a couple of weeks? What are the major risk factors that lie ahead that could potentially derail this rally? What tailwinds, what headwinds are there that exist? That takes just timing and experience. But for now, find a low volatility ETF and just sell calls and puts. And you're not really doing it to make big money on this one. You're doing it to get a feel and get practice. So your option should be a delta of 0.1 to 0.16. And again, you're not making big dollars here. You're just getting comfortable with doing that first. And then you can slowly increase the deltas that you're using, and you can slowly increase the beta of the security you're using. And so as you increase your delta, you increase your beta, you will increase your profits. Also, your losses. Let's not just say that there's one side to this, right? As you described, the expectation is that the Fed will achieve its goal by hiking to about 5% and pausing. That is what the market is pricing in right now, that the Fed will get to 5% and then just kind of hang out there all of 2023. 2023. We're in 2022 now. What if not? Well, then that's better. When you say what if not, I'm not sure if you mean lower or higher. Do you see the possibility that they move the goalposts and accept 3 to 4% inflation as acceptable? No, I don't think that they would accept 3 to 4% as acceptable. They want price stability. That doesn't necessarily mean inflation. There's a belief that because of the way CPI is counted, that 1% CPI is the borderline between inflation and deflation. And the one thing they don't want is deflation. So if 1% is the borderline between inflation and deflation, and the last thing you want in the economy is deflation, let's bring it to 2%. In other words, they're not saying we want inflation. They're saying we do not want deflation, and if 1% seems to be the cutoff, let's push it to 2% and target 2%, so we're kind of above that 1% line where it's believed that that is the cusp of inflation versus deflation. So we want price stability for far enough away from the deflation point, but not so far as to be the basis of why value is being created in a nominal sense. So no, I don't see them going to 3 to 4% unless they have some belief that 2% is the cutoff for deflation, or 3% is the cutoff. Also, if something breaks in the economy before they achieve their tightening goal, what do you think is more probable, reversing QT or cutting rate? It depends on what breaks. If something breaks in which they can deal with it directly, deal with that thing directly, they will. If it is more systemic, then they may have some tool that deals with that level, with that issue directly, but something would have to break in such a way that the only way to fix it is to back off of everything. In other words, back off of QT, maybe even go out and start buying stuff again, and back off of rate hikes. However, look, we're at 3.25. Bank of Canada just went this morning to 3.75, 50 basis points instead of the 75 that was fully expected. And the Bank of Canada was hawkish. So, the market has digested everything that has happened so far without really anything breaking. Sure, there are stresses in the system, but there's stresses from other sources that have their own tools to deal with those stresses as well. So I think that you would have to have some exogenous event happen that has the potential to have a cascading effect unless you do something for the market to instill confidence very quickly. In other words, nothing will have to break. There only has to be the potential that something that breaks could cause even bigger breaks, and then central banks will say, okay, we need to instill confidence in the market, let's do this. Okay, at the start of this year, I started increasing my allocation to short duration fixed income, which ended up being a good idea. Now I'm wondering how to decide where to position myself in the yield curve and whether to do corporate debt or government debt. The purpose is mostly capital preservation and minimal growth, to deploy it slowly when the markets calm down. Trade-offs are clear, but I'm looking for a principled approach to answering my questions in general. Well, if what you're saying is that you don't know when you're going to want this liquidity, but you want that liquidity available for when markets calm down, you don't want to be in 10-year bonds because, well, what if you're underwater when you want that liquidity? You're going to have to sell your 10-year bonds at a loss just to buy equities. You want to be able to have zero loss. Cash is 3.25% right now, and in a week, if the Fed moves as the market expects at 75 basis points, cash is 4%. There are lots of money market funds that you can sit in that will yield 4% starting next week. Just go to a money market fund. Simple as that. Let's see. Are the nominal and real yields that we look at on a weekly basis the overnight rate of so far? No, they are Treasury. They're from the Treasury, so they are T-bill and bond rates. If so, and if so for rates or overnight rates, how are we able to construct a relevant yield curve or term structure of overnight rates? You use swap rates. When we look at the treasury rates, we are looking at par rates. So the yield curve we look at is a par curve. A par curve is a swap curve. A swap curve is a par curve. So on CME, you can go to the CME and look up swap futures, and you have a bunch of different types of swaps here. Max swaps. You have the I think there are error swaps in here. Error swaps have a particular methodology. They're meant to kind of be a sort of a replacement for a swap, kind of an all-in-one contract. The MAC is a market agreed coupon, which is the common swap that you would enter into, an interest rate swap. So because these are swap, this would draw out a swap curve. A swap curve is a par curve, and those are the rates we use. Also, Chatham Financial. If you Google Chatham Financial SOFR rates, you can get swap rates based on 1 month, the 1 month resets, or annual resets, 1 year, 2 years, all the way out to 30 on each of them. So a little Google search will find you plenty of results. You can type in SOFR par curve or SOFR swap curve, and there are plenty of sites that will give that to you. Second part of that question down here, should we be using SOFR rates as a risk-free benchmark rate as part of valuing debt? As part of valuing debt, well, it is now kind of you could argue that it is a risk-free rate, because it does have to be collateralized, because it's a secured overnight funding rate, whereas LIBOR was an unsecured overnight funding rate. And because it's secured, you could say it's a good enough proxy for a risk-free rate. It depends. You can price out debt based on a spread over treasuries, or you can price it out as a spread over the secured overnight lending rate, so which would be called the swap spread. You can do it both ways. I don't know that one, I don't know that there's a reason why you couldn't, depending on what you're trying to get done. So without knowing more, it's like, well, you can use both, is my best answer. I imagine LIBOR rates are still being published, so we may not fully transition to SOFR yet. The move is, I think, almost done. This is most LIBOR is either transitioned out, and most contracts are already citing the SOFR as the reference rate. So if you're doing anything, I wouldn't start building any system around LIBOR. I'd be building it around SOFR. There is a difference in the way they're quoted, right? LIBOR is quoted as continuously compounded. SOFR is not. So with SOFR, you have to make a decision whether you're compounding your overnight rates or you're using simple interest. A lot of systems that are out there are only programmed for simple interest. So if you go to the New York Fed has an opinion piece on how to implement SOFR, and they do talk about how you would deal with determining longer term rates, whether you would be compounding the overnight or whether you would be using simple interest. So depending on what it is, how complex you're trying to get, I would read that opinion piece on SOFR from New York Fed. The spreads are surprisingly wide on September 29th, 2023 SPY options. Okay, right away I see a problem. This is not a regular expiration date. SPYs have lots of different expiration dates. Go to the third Friday in September, which is the normal expirations date, and you'll find a lot more liquidity on the options. If you're going far out, 6 months, 7 months, 8 months, and you're trying to find options close to the strike, close to the at the money, they're fairly liquid. They really are on regular expiration dates. But when you go on the off weeks, liquidity is very, very low. Most traders will want their options all expiring on the same day every single month, so they don't have to handle a whole bunch of multiple expirations. So pick the third. That I know the 29th is not the third Friday of the month. Pick the third Friday of the month. You'll get it cleaned up by quite a bit. However, it doesn't mean that you're going to get very tight spreads. But if you're doing a synthetic at the money, the synthetic should cost you nothing. In other words, once you sell the put and buy the call, if you're very close to the ATM, and since you have $1 strikes on SPY, you should be very close to ATM. Your bid to ask should include zero. So you might have a bid of negative 0.26 all the way to an offer of 0.34. Just stick a zero in there for the offer price, and you'll get picked up. If you're off the money, let's say that SPY is at 385 and you're trying to construct a 375 synthetic, well, it's already $10 in the money, so you're already going to pay $10 for it. You would be paying whatever intrinsic value you happen to have. You're going to have to pay that intrinsic value, but since it's a synthetic, your delta will equal 1. And if your delta equals 1, you should be basically paying the stock price. Which means if your strike price is 385, there you go. It should cost you 0. If your strike price is 384, it should cost you $1. If your strike price is 380, it should cost you $5. If your strike price is 390, you should get $5. And that's the bid you put in. And the market will pick you up. I mean, if you put in a reasonable bid that's in the middle of that spread that's reasonable, the market will pick you up. But I think this is a big problem you have right here. Let's say, I don't need to read the rest. I think, let's see, would you be able to walk through your thought process in terms of how you manage this? Did approach 1285 IBM. What would you do if you got assigned early on the put or the call that went in the money? Well, you are short a call and you are long you're short a put and long a call. So if the price goes up, you don't have to worry about anything being exercised because you have the right to exercise. The only time you have to worry is if the price goes down way below the put price. You will more than likely be put, especially at high interest rates. As soon as the interest on the strike price for the remaining time period exceeds the time value left, and the further in the money this goes, the lower and lower the time value component becomes, it will be put to you. And it'll be put to you without notice. It's not as if they say at 1 o'clock, hey, close your position or this will be put to you today. It is put to you, and usually you find out in the middle of the night that it's put to you. After hours you find out. The next morning you could just close it down. It's not a big deal. You could just flip it into another put. It's not a big deal, but because you're selling the put and buying the call, the only concern you would have is to the short side. Where do you obtain the data tables on treasury yields? You get them at treasury.gov. There's a menu across the top. Look for the word data, and a big menu drops out, and it's the very first column that has all the treasury yields. Federal funds rate, CME, real yields, that's at treasury.gov again. Credit spreads you can get off of Fred, or you can get right off of Coifin. So lots of sources there. If you look at the links below in the description box below every market outlook, I leave you the links to go and get those things directly. After the close on 10/20/22 Thursday, the probability of 75 basis point in November was 97.5. Probability of 75 was at 77. On Friday, the probabilities changed dramatically. I don't know that I'd say they changed dramatically. I saw them on Friday. And Treasury yields dropped. Several news articles claimed the reason for the rally in the markets was San Francisco Fed president, that was daily, saying it was time to start thinking about decreasing the size of rate hikes. Do you think the Fed may be forced to do more in November-December meeting if financial conditions keep getting looser as a result of positive forward guidance? Well, that is the tightrope that they have to walk at this point in time, is they do have to slow this down. I mean, everyone knows that they have to slow this down. They've done a lot. And since this works with a lag, you have to raise, as they said, we have to get ourselves into sufficiently restrictive territory and hold it there for an extended period of time. So the market is anticipating, we have rate hikes, the market is anticipating this going on. That is called a Fed pause, not a pivot. One of the most overused and misused words of the year is the word pivot. I think it's time just to retire that. Just strike it from the dictionary so no one else can ever use it again. So we have this. Actually, this is probably not a very good depiction. We've had 75, 75. We might have a 50 and a 25 and then go sideways. So there is a deceleration. Markets tend to pick up on decelerating data. So when bad news starts getting less bad, markets rally. When good news starts getting less good, markets sell off. So it's the inflection points that markets tend to play, which is why we say they're leading indicators. Because if the data if rate hikes are decelerating, at some point they will pause. The market will anticipate the pause because of the deceleration, the second derivative, right? Which is a problem for the Fed. Because what they don't want are those treasury yields beginning to rally, those credit spreads beginning to narrow, and equities starting to rise, because that would ease financial conditions and give everybody a sort of a green light that everything happens to be okay. This was the summer. You could argue that the Fed caused it themselves by even projecting that they were going to slow down. I think the wisest thing to do is in November, because they have not programmed the market for 50 yet, is to go 75 and to say, we are to really stress the fact that we are not cutting rates anytime soon. We're going to be slowing down soon. We're almost there, but we're not cutting these things at all, and they really have to speak that language. I think they want to try to walk a fine line. They don't want to spook the market and give the market reasons to sell off. They're not out to destroy value, but they don't want to rally. What they want to tell people is, listen, stay right where you are and everything will just be fine. So it's a job I wouldn't want at this point in time, because you have to project an end to this. Everyone knows there's an end, but you can't have the market throw a party because the end is near, only to have rates drop like they did in the summer, and have an August where housing sales went back up, pricing stabilized, and when you looked at the September data, all of a sudden the August inflation was right back, because the August report showed for July that there was almost no inflation, that it was gone. Remember Biden coming out saying, there's no inflation, folks. Inflation's gone. It's gone, folks. Remember him saying that? Well, now it's back, right? They don't want to repeat that. And I don't think they want to get into a 70s style hike, pause, hike, pause, hike, pause. So they have to, I think, talk tough to the market. It's going to be interesting. I don't think the decision matters anymore. It's all about the press conference and what they say in the press conference that's going to matter the most. Okay, I had a question around the best type of thinking when looking at homes. I live in Australia. We only have variable mortgage rates here. Say you had a house of $600,000 at 3% versus 6%. You would now be looking at an increase of $400,000 in total cost over the life of the loan. An increase of 40%, give or take. I understand rates won't stay here, but over the next 30 years, I could see the mean being around 6%. Over the next 30 years, you could see the mean being around 6%. I don't know. What do you think the current price of a $600,000 home should be now that rates have doubled to 6%? Well, if you have a market in equilibrium, then and you're saying that there is a monthly price to a house, as opposed to a selling price for a house, there's a monthly price for a house because it's a combination of interest and housing price. That's a little bit difficult to get done. You can say only for yourself that I can afford a $600,000 house at 3%, but now that it's 6%, I can't afford a $600,000 house, I can afford something less. That does not mean the seller's going to sell it to you for that. And that does not mean every buyer will use the same level of debt that you will use. So houses sell and they're priced on what's called an unlevered basis, meaning that the house price is agnostic of the level of debt you're going to use. Because if that were the case and you had to use debt and I had cash, I could always outbid you. I would buy every single house there is because I'm unlevered. You're levered. And I could always buy them at a lower rate. So houses always sell to the unlevered customer. The fact that you have to use debt, that's your problem, isn't it? That's not the seller's problem. That's kind of your thing. There would be a much different cost if you had 5% down versus 10% versus 15% versus 20%. There would also be a difference in cost if you were paying monthly, bi-weekly, or weekly. There would also be a difference in cost if you have prepayments that are allowed per year. Most mortgages allow up to 15% of the purchase price to be prepaid on the anniversary date of the mortgage. So if you take advantage of all of those things, then you can manage the cost, your interest cost, in a much different way. But that's not for the seller to determine, because the seller would then have to say, well, every buyer is different, but there's only one seller, me. So it will sell based on its unlevered price. What do you do? Well, you have to determine what your affordability is. Keep in mind, what you want to do is you're standing here at this point in time and you're saying, well, over the next so many years, I'm going to have a mortgage, but your income is going to do this, hopefully, over that period of time, while your debt is going to do this, right? So as time goes on, the spread between your increased income and the reduced principal you have on the house changes. So you can't look at, well, if I get a house right away, my first month, it's going to cost me $4,500 a month. You have to say, well, that is, let's say, 45% of my budget. Well, next year it might be only 42% of your budget because you got a raise. Then the year after it might only be 39. Then it might be 36. You have to sort of project out and do some budgeting. Your first 15 months might be tight. But then after that, it starts to get easier and easier, and especially if interest rates go down. If you have a floating rate mortgage and rates go down, well, then your monthly payments drop at the same time. In the end, what you're buying here is an asset, is a long-term appreciating asset. You'd like to buy assets that appreciate at a rate faster than the weighted average cost of capital that you're using. If you're using the majority of it being debt, that's the cheapest financing you can get. Can the asset that you're buying grow at a rate faster than that? If you're paying 6%, I think looking out over the next so many years, can you continue to get 6% per year on average? I don't know, but I don't think that you're gonna have a mean reverting level of 6% over the next 30 years. Can you go into more detail how the multiple of the market is determined? Well, there is no one single way in which it's determined. It can be compared to certain things for you to make an assessment about whether you think it's fairly valued, undervalued, or overvalued, but there is no method to determine the multiple on the market. If there were, there would be one algorithm that runs everything. So all we have are methods by which we can assess the desirability of the metric. You say here that they're tied to treasury yields. Well, if we take a 10-year treasury and we can get 4.1%, that is a combination of coupon plus capital gains, because we don't always buy bonds at par. We can buy them at discounts and premiums, but that 4.1 says if we hold it every single year, we will yield 4.1% per year to maturity. If rates rise, we'll yield a little more because our coupons can be reinvested at higher rates. If rates drop over that period of time, we'll earn a little less because our coupon will be reinvested at lower rates. So if we can get 4.1 and we're going into equities, we should be getting some equity risk premium off of that. And there is the earnings yield, right, which is earnings over price. It is troublesome to use this in a sense because this here is fairly precise. There is a cash flow that you get. There is some future par value that you get, and that bond will amortize to par. Well, there is no guarantee on the price, and earnings are not an economic outcome. They are an accounting outcome. So when we do this ratio, it is just a rough way to look at things. And let's say that E over P, another way to get this is 1 over the PE multiple. So 1 over, if we have 17 right now, let's say we have a multiple of 17, that is 5.8, we'll call it 5.9%. So you have to ask yourself, is an equity risk premium of 1.8% suitable? Most market participants would say no, it is not. But what we have to do is think, well, the 10-year, what's it going to be, over the next year? Maybe it'll get down to 3.5%, and maybe the price on the market will rise, thereby giving it what appears to be a lower PE. So if we had a price rise and the PE were 16, you would be at 6.25% versus 3.5%. Now you're getting, 2.75% on the equity risk premium. Is that sufficient? So it's just a kind of like a back of the envelope kind of calculation where you can do to just, determine whether or not it makes sense. At 1.8, I don't think it makes a lot of sense to take on that kind of risk at 1.8. Same with 2.5. It should be around 4%. That's a nice spread. So if you're calculating the two and you find that there's a 10-point spread between them, yeah, that makes a lot of sense. But when they're this tight, you have to say, doesn't look like I'm getting a lot of help there. It's not as if you just say, oh, well, stocks are too expensive. You just say, it's not clear-cut enough. Let me use another technique. But there is no one way to determine this. There is this methodology, but it has it's easy to criticize because you're using earnings. Well, we don't really receive earnings, but bonds receive the coupon. You actually get that cash. Well, we don't receive earnings. We receive dividends. And earnings are accounting outcomes, not economic outcomes. So maybe it should be a cash flow yield using cash flow from operations, or maybe it should be a free cash flow yield because some businesses, to remain in business, have to keep reinvesting in their CapEx. That's called maintenance CapEx. So maybe it should be the free cash flow yield that we should use as opposed to the earnings yield. You can get a little bit more fine-tuned on that, but just don't get married to this methodology saying, aha, it's just one way of assessing. Do you think the full effect of interest rate hikes hasn't caught up with the earnings season yet? And that's why it's a little tricky to trust the Q3 positive earnings. Well, Q3 was going to be positive. We know that. It's guidance that was going to be rough. But Q3 was primarily going to be positive, except for the discretionary things that companies could cut very quickly. And we're seeing that when it comes to advertising, whoever is selling advertising isn't doing very well on that. Keep in mind, most companies, if we're thinking about the cost of their debt, they've already had that debt on their books at low costs. Just because rates are going up doesn't mean the cost on their debt is going up unless they have floating rate bonds. But if they do, they probably would have swapped out for fixed rates long ago. It is only newly issued debt that is a bit of a problem, and even that is not that expensive when you consider the after-tax cost of debt versus the cost of equity. The cost of capital is slightly higher, but not cripplingly so. The only I think the only way that it would show up in earnings is consumers pulling back on certain things. So we do see it in consumer discretionary, but it's guidance because listen, you've had employment increase all year, which means aggregate wages have increased, which means the amount of money being spent in the malls is increasing every week. And sure, they're paying higher prices for stuff. So we have to ask, is real activity increasing? But it doesn't matter if real activity is increasing, which we get with real GDP. Earnings are nominal. Earnings are nominal. We can look at real earnings, but no one really looks at real earnings. They look at nominal earnings. So you have the impact of inflation on top of all those earnings. So I don't know that interest rates need to show up in the earnings yet until it impacts enough employment and enough spending at the consumer level. Well, a lot of mortgages in the U.S. are fixed rate mortgages. Majority of them were negotiated before the hike in rates because home sales have been pathetic since the hike in rates. That means only those new people, only those new homeowners have the higher mortgage rates, not the older ones. Some people have floating rate, but it's low. Overall, it's the impact has not hit yet because no one has been impacted much yet unless you've taken on some new debt. As the Fed says, this does work with a lag. It takes time to work its way through the system. Where you will see the effect very quickly is marginal spending. In other words, CapEx. CapEx will be evaluated based on elevated costs of capital, including the new cost of debt now, especially if a company has a debt equity ratio that it wants to maintain. Whatever CapEx will be financed with debt and with equity to maintain their capital ratio. Well, that's where you're going to see pullbacks, is in CapEx. Okay, I know that Interactive Brokers provides all the year-end tax forms required, but do you have a framework for tracking your transactions and taxes in real time for planning purposes? Have you considered adding something like this to the options course, considering things like wash sales basis versus, well, at the end of the year, you get a worksheet. You can download the full worksheet, and you can just, it's all chronological. So, and it's all based on every security. So let's say that you did a lot with Apple, AAPL. Well, it will list all the transactions, buy, sell, all of those, and when they occurred, the dates that you bought. So let's say that you bought, you sold, you bought, you sold. Well, you can, it's already done for you. So it'll tell you how much of it was short-term gains, how much was long-term gains. It'll tell you how much is unrealized, so you know how much, what you're still holding at the end of the year. So it already has the worksheet for you. So you can download that worksheet weekly. You can set any date range that you want. You can download it weekly. You can download it daily. You can generate it quarterly, monthly, however you want. I don't waste my time with that. Because IB does the whole thing for me, and if I need to at any point say, what's my P&L for the year on Rio Tinto, I can just download a year-to-date statement, and I can look at all the trades I've made, and it'll sum up my totals for the stock, and it'll tell me whether I'm in a positive or negative position. I can add up all the options, which I just have to look down at the total, and it'll tell me if I'm in a surplus or deficit position. It'll tell me how much was short-term gains, how much was long-term gains. I can look over at my unrealized to say, okay, well, do I have any exposure to this particular stock right now? And then, I can figure out what my incremental tax hit is from just that based on what's short-term, what's long-term. So use that. Number one, 20% of my portfolio is U.S. denominated. I'm a European-based investor. What would be your approach to hedge the currency? Well, if your portfolio is U.S. denominated, that means you are long U.S. dollar assets. So to hedge, you need to be short some U.S. dollars. So you need to find a way to get short U.S. dollars without creating in your account a negative currency position. best way to do that is with futures. However, they're, I think, 100,000 on the underlying for futures. So when you say 20%, if your 20% only amounts to 10K, well, that's going to be difficult to hedge out using futures. There, you do a spot transaction. You'd short the U.S. And go long the euro on that one because you're already long the U.S. by 10K. So if the U.S. strengthens, well, you'll get the currency gain in your assets, but you'll lose the currency gain over here. But that's what you want, right? You're not making a currency bet. You don't want to make a currency bet. You want to hedge. So you have to find a way to get short U.S. dollars. I found some interesting options on Canadian market. It also relates to the question number one. Would you suggest I only play the option game so my CAD exposure would be minimum? The reason I suggest using options is for a couple of things. It minimizes your exposure. And number two, it avoids any dividend withholding tax by turning the dividend into the premium, and the premiums on the options will reflect the dividend. So if you're doing a synthetic on an option, the entire dividend is within the combination of the call and the put price. The present value of that entire dividend is in there, so now you're getting it as a capital gain and minimal to zero currency exposure because the synthetic at the money costs you zero, and you can use euros as your margin against that position. You don't need Canadian or US as margin against that. Let's see, what is your information workspace and discipline? What information sources do you use? I use as many direct sources as I possibly can. So if I want to know what rates are, I will go right to treasury.gov. If I want to know what the probability of the next Fed rate hike is, I will go right to the CME. I go right to the source. If I want to know what inflation is, I go right to the CPI report itself. I don't rely on news sources to get my information. You find the source, because all these news people are doing is going right to the source and getting the information. And if it's economic information or financial information, it must be made available to every participant at the same time. No one can have an advantage. So if the Bureau of Labor Statistics is releasing the Friday jobs report at 8:30, it's on their website at 8:30. Everybody gets it at 8:30. No one has an advantage. Now, there are some private companies that produce data, like ISM, like S&P Global, like the Conference Board, where they will report the headline number, but if you want the full report, you actually have to pay for it. But because they have a headline that they're reporting, they have to make that available. They can't share it with some people first and then tell everyone else. They have to make it public all at the same time, but they can dictate how much of it is public. For companies, go right to their financial statements. In fact, if you want to avoid the securities filings, because they're done in a certain way, go right to every company, go to their investor relations site, and they've already compiled the data in beautiful presentations with beautiful charts. You can use those. You can use their investor presentations, or you can use their annual report that's written for the investor. And if you say, well, I don't trust any of these numbers, you can verify them with the SEC filings. It would be rare that a company would decide to lie to you on an investor presentation when it could easily be verified that they're lying by looking at their financial filings with the SEC, because somebody would catch that. They're not going to take it. So you can rely on what they're giving you, and oftentimes they're already giving you a 5-year history or a 10-year history of a particular ratio. For example, like funds from operations will show you maybe the last 5 years and the growth rate over the last 5 years. So a lot of that is done for you. Every company you want to follow, investor relations, you can sign up. You just sign up for notifications, or they'll have a news department. You can sign up for notifications, and every release you get an email with the news release every single time. You can even do this with some of the economic data. You can just put your name down. There's usually a sign-up form. You put your email address in, and when they release the information, you get a notification that the information is done, and most of the time they send it to you. I know I get the grains report at 12:30 every Wednesday, or is it 1 o'clock every Wednesday? It just gets sent to me, so I never have to go, oh, I haven't checked the grains report for a while. I get it every week. As far as my workspace and discipline, you get to a point where you don't really need a list of things to go through. It's more holistic. You just, it's not a set of rules. It's just a state of mind. It's just some things become interesting to you as you hear them. Some things require inquiry as you see them. Some things you look at, you go, oh well, I don't need to look into that. I know what's going on there. It's I don't know how to explain it. It just kind of evolves over time to be something that you just know. You don't know what you're going to do, you just know you're doing it. That's about the best that I can say for that. Okay, can you describe DDB measure and how to calculate it? All right, so let's say you have $20,000 of a stock that has a beta of 0.8, and since stock has a delta of 1, we could just write 1. If you multiply all this out, you get 16,000. And if you feel for some reason you want to bring your exposure, your market exposure down to 0 without having to sell this, well, we have to bring in something. We need negative 16,000 in dollar delta beta. If the SPY is running at 384, since every options contract is for 100 shares, the underlying is 38.4. If you take your 16,000 and you divide by 38.4, you get 0.416, which means you want to find an option that has positive 0.416 delta and sell it. Or that has negative 0.416 delta and buy it, because you need to add negative 16,000. So if you take 20,000 times 0.8 times 1 and multiply it by 38,000, you take all of this, this should equal 38,400 times it. It'll have a beta of 1 times 0.416. They'll equal, and that will get your dollar delta beta down to 0. It's just a way to find one common metric on which you can size everything, as opposed to saying, but this has a beta of 0.8 and these are shares, this has a beta of 0.1 and these are options. How would you do that? You multiply dollar, delta, and beta together, and you have a common metric. They're both expressed in the same metric, which is DDB. Next, in the first months of 2022, before the Fed started to raise the interest rate, there was a narrative in the market that said banks would profit from higher interest rates. Could you interpret that, and what went wrong for banks? I usually don't answer questions along the lines of I heard, I read, I saw somewhere, because I don't know where you read this. I don't know where you heard this. Who was the source? Are they credible? Are you sure this is what you heard? Did you hear it correctly? Are you repeating it correctly? You're asking me to accept the lot. And when you say what went wrong, what did go wrong? You tell me what you think went wrong, and maybe I can answer it, but what went wrong? I don't know. I'm going to have to go through all the banks to say, well, what specifically went wrong? What are you talking about? Not enough information here to even begin, and it's based on something you heard, you read, you saw somewhere, but you can't remember what it was. There was a narrative, but where was it coming from? Who said it? So can't really help you out there too much. As far as higher interest rates, that's not a threat to banks in terms of how they can make money. It is the shape of the yield curve that matters, not so much the level of interest rates. If rates go up and rates go up across the whole curve, well, that's fine. Banks borrow at the short end and loan at the long end. Banks can structure their liabilities such that they pay a certain interest rate, and they can structure their assets such that they receive a certain interest rate. So they can engineer a spread between the margins. So higher rates on their own don't hurt bank profitability. Higher rates deter people from wanting to get loans, so it slows down credit formation. So it slows down the ability for them to build more assets. If the rates go high enough and it hurts the economy, it may increase defaults. But when it says what went wrong, I don't know. What went wrong? What do you think went wrong? I mean, banks do a lot more than lend money. So, they have fees, they have different types of business, they have underwriting, issuance, M&A. They do a lot more, and all banks have some kind of trading arm. So there's a lot more than just net interest margin. You can do quite well in net interest margin, but suffer in wealth management, suffer in issuance, and underperform for the year, but that wasn't necessarily because of higher rates. Or it wasn't necessarily the effect of higher rates on the lending, borrowing and lending you do. Next, we are in earnings season. If you're waiting for a specific company's earnings, how do you manage it? Okay, I don't know what I'm managing if I'm waiting. Do you listen to the whole, oh, I see. Do you listen to the whole earnings call or read every single form they release at the time? Which one has higher priority for you? It depends. Some companies are critical that I want to know as much as I possibly can about them, especially if they're larger holdings, especially if I'm thinking about increasing my exposure to them. I'd want to know quite a bit about them. At other times, I have some companies that I hold that I've followed for quite some time. I no longer read their statements because I have faith in management at this point, and I have faith in the business model the company is using. And quarter to quarter, I don't know that I'm going to get much more detail by diving into the statements, but I will read the press release. And if something jumps out at me on the press release, well, okay, I'll dive a little deeper. If it's a clear miss in some way, well, then what happened? Is this an event or is this a trend? If it's an event, okay, it's an event. I'll use the pullback to buy more. If it's a trend, well, then I better start thinking about selling some calls on this or lowering my position. Sometimes I don't own shares of any company at all, but I want to listen to the earnings call, because what they say matters to some other aspect of the economy, so that the home builders, even though I don't own shares in all the home builders, I listen to all of them because I want to hear what they have to say. Some REIT companies I listen to, not because I own shares in their REIT, but because they have a leading position in their market. And I just don't find them at an attractive enough valuation, but they got a leading share in their market, and I want to hear what they have to say. Because if they're feeling something, I know the smaller ones behind them are going to feel something as well. So I want to be aware of what they're feeling. It depends. Let's see. If you want to listen to the earnings call or read everything, you're probably going to need more than 2 hours. Well, yeah, a lot more than 2 hours. Is there any faster? Okay, well, now you're looking for the least amount that you have to do. The least amount you have to do is nothing. You don't have to do this. If this is a big pile of work for you, if 2 hours is a big pile of work for you, don't do it. Do something else. You don't have to do this. But if you're going to be a part owner in a company, when you buy shares, you are the owner. Management just manages the business. You are the ultimate owner of that business. And you don't have 2 hours to dedicate to a company that you own, then that tells me that you're not really concerned about things, that you care more about the buying and selling at a higher price, just the money you're going to make. This is all you really want, but you want to try to minimize the amount of time it's going to take for you. I don't know. Maybe I'm reading too much into that, but it's probably going to take more than 2 hours. Is there any faster process? That seems to me like that student on day one putting their hand up in class. Sir, do I have to read the book? Sir, do I have to come to class? Sir, are your slides enough for the exam? Right away, trying to figure out the least amount of work they can do to get by. I'm going to use that for your next one. Applied seriously, since you have knowledge and experience you need, wouldn't it be nice to add a series for career path? I am far removed from the job market. I think you have many young subscribers, followers like myself between the age of 20 and 22 who would appreciate an expert's advice like you. Well, my advice is change your attitude about this. Because you're not going to have a career. You're going to have a short tour of duty, and if you have this mindset in your job that, it's so much work, it will be obvious to them, and you're not going to enjoy it, and they're not going to enjoy you not enjoying it, and they're going to part ways with you sooner than later. You don't have to do this. You get to do this. You get to listen in on that call. That's actually fun to do. If you've ever really sat through conference calls, the first part with the presentation, yeah, it's boring. I never listen to that. I have it on because it's on, but I really start perking up when the analyst questions show up, and they're usually about half an hour of questions. There's usually 6 or 7 analysts that'll ask questions. You get to know who the analysts are. You're listening to their question. You're listening to the types of questions they ask. So if you're looking for career paths, listening to a whole bunch of conference calls is an internship. If you're willing to do an unpaid internship somewhere, sit at home for 2 weeks and go through a whole bunch of earnings calls, that's an internship, because now you're training under a whole bunch of different analysts. You're listening to the type of questions that they're asking. But make sure that you read the presentation first and then listen to the analyst questions so that you're prepared, so you can learn from it. If that to you sounds like a whole pile of work, stay away from the finance industry. There is probably no better paying industry in the world in terms of something that's accessible. And I mean accessible meaning you don't have to be an actor, a singer, or an athlete. Something that's accessible. There's probably no better paid industry, but it's also the single most competitive industry in the world. Other than, of course, entertainment and sport. But it's probably the single most competitive discipline in business to be in at all levels. Management is competitive, but usually at higher levels it starts getting more competitive. But finance is competitive from the time you step a foot on that floor, because everybody there wants to be there. Everybody there, is passionate about it. So if you're 2 hours. Do I have to read it? Do I have to do, if that's your attitude going in, don't even do it. Pick something else. If you don't see this as something you get to do, if this doesn't turn you on, if this is not the game you want to play, pick something else, because you're not going to make it and you're going to be miserable. So I would say the best career advice I can give you is change your attitude about that. Okay, could you please cover how analysts produce their estimates for earnings and revenue? What data they go through? They typically is bottom up. So they'll have a spreadsheet model where they'll forecast out revenues over a period of time and earnings over a period of time. Since they're just forecasting the next quarter, that's really all they're really concerned about, and their model is forecasting that next quarter. They might not be forecasting out 5 or 10 years, but if you're an analyst following a company, you're going to have a number of things. You're going to have a long-term forecast, you're going to have a price target, and you're going to have your quarterly forecast. You're going to have your next year's forecast of earnings. So there's a whole bunch of output you get from it, but the estimates are analyst estimates that are bottom up. So it's not as if there's 13 analysts giving you everything for the S&P. Some companies have 30 analysts. And consensus is the consensus of all the bottom-up estimates. We see that on average earnings beat estimates, so I wonder, couldn't analysts intentionally estimate the projections of the earnings report? Always positive surprise to the market. This follows a principle of being conservative. It is far more dangerous to be wildly optimistic in your forecasts and set the bar high and earnings come in lower, even though those lowered earnings beat everybody else's expectations. And that you were right in that they were going to do better than the consensus, but they, underperformed you. So by being conservative, because you're going to bet money on this, by being conservative, you're saying, well, instead of 6% growth, maybe they'll only get 5% growth. Instead of 28% margins, let's model 27 or 26.5% margins. You're going to be a little bit conservative, so that if the numbers you come up with would sort of be, I guess I wouldn't say on the low end, but if you're investing based on those numbers, not bad. Because they were not as aggressive or not as optimistic as you thought they might be. So there might be a bias to be conservative in estimates. I'm having difficulty. I should finish up with that one more. Sometimes the estimates are just taken from the company itself. The company will offer guidance, usually within a range of guidance, and that could be the starting point for analysts as well, as it start with that range and say, do I have any reason to disbelieve that this range is incorrect? And maybe they start from there, but typically they're bottom up. Having difficulty grasping why rates are increasing even though there seems to be a lot of demand where retail investors are buying treasuries due to higher yield. Unless you have some data that shows that there's more buyers than sellers, this is not an anomaly. Okay, so I know somebody that bought bonds. How come yields went up? Well, it just means there's more sellers. It doesn't even have to be more sellers. It just means more bonds being offered for sale than being purchased. Higher demand of bonds. We don't know if it's higher. Higher prices, which should lower the yields. Well, here's the thing. If you see a stock price go up or a bond price go up, that means the dollars coming in to buy it exceed the amount of supply available to satisfy the buyer. So you could have 1,000 small buyers or one big seller. And if you have a big seller that's bigger than the 1,000 small buyers, the price is going down. So it's not the number of buyers and sellers. It's the amount of buying power and selling power that exists in the market. And if prices are moving up, that means there's more buying power. Plain and simple. Plain and simple. If prices are moving down, it means there's more selling power. That's it. So we don't have to say, how come there are more buyers than sellers, but the price is going down? That can never be. I consider myself quite advanced in finance. I haven't managed to find out something rather simple. How does a retail investor, not US based, invest in 1 year or 2 year treasury and lock in 4.5 it currently offers? You just buy it. So with Interactive Brokers, for example, I can buy bonds in different countries. You just buy it. If you have a broker that doesn't offer bonds, you will have to call a broker to get it done because bonds are still an over-the-counter product. However, a lot of treasuries, a lot of government bonds are available on trading platforms. So if you do have Interactive Brokers, you can just buy the bond. The real bond, yep. Ideally not more than 5K nominal position. I believe they're all $1,000 face value. Hold to maturity, not a 1 to 3 year ETF. No, the ETF has a what's called a duration target. The problem with the ETF is that the duration of the ETF is fairly constant. Yep, as new bonds are added and bonds close to maturity are sold. So okay. So yeah, you just buy it, just straight out buy it. Let me add one more thing. That I don't know. It says here that you're not U.S. based, so I don't know what country you're in. There may be some capital restrictions in the company you're in that disallow you from doing that. I don't know what they would be, but I can't possibly speak for every single country on the planet, whether or not you can or cannot. You might be in a country that disallows you from actually doing that, or you may be in a country where the U.S. disallows you from doing that. That could be a possibility. I don't know. But if not, if there's no capital control restrictions, and restrictions on foreign ownership of domestic assets, then just buy it. Okay, could you also touch on emerging market debt? It's not really my thing. Due to continued pressure on EU credit, there are talks of exit yield. I'd like to know how one would enter these trades as a distressed investor. Unless you have a skill set as a distressed investor, I wouldn't even touch it. Unless you know the legalities and how to navigate that particular market, stay far away from that stuff. If one does not want to take more extensive margin risk, what is your opinion on using call spreads and put spreads instead of selling naked calls and puts to replicate your strategy, selling calls on green days and puts on red days? Yeah, you can do that. But understand that if you're using, if you sell a call and you buy a call further up, this one will have a delta of, let's say, 0.4. This might have a delta of, let's say, 0.25. As the market increases, both of these will increase. As the market drops, both of them will drop. So the long call is going to drop in value, giving you a loss, but this will drop in value, giving you a gain. So when you do something like this, You don't have a delta of 0.4, you have a net delta of 0.15. It does significantly lower the margin requirement that you need, but it also significantly lowers the payoff that you need. But you can always say, well, if I would have sold one call at 0.4, I can do 3 call spreads at the same time, and you'll still have much lower margin than one call by doing 3 call spreads, and you'll get your delta to about the same place. Yeah, you can do that. Just keep in mind that you're going to win on one and lose on the other, so that your delta of the position is what you have exposure to, not this delta, right? That's offset by the other one. Let's see. What is your take on holding securities in DRS physical certificate versus on deposit with brokers? I guess my big question is, why would you want to? What is motivating you to do that? Because you lose liquidity. If you have stock certificates, that's great. That means it's not held in street name, so your broker doesn't have those securities in your account. Your broker doesn't know you have them anymore because you're holding them. They're not. They don't have them. So if you put an order in to sell, your broker says, well, I guess you're taking a short position because you don't have these securities. So if you do want to sell them, you first have to transfer them to the broker. Well, maybe the broker doesn't want to do that. Maybe the broker says, we don't accept transfers in. You'd have to find a broker or a bank that's willing to accept it. It could be up to 10 days before you actually get to sell them. So hold them in street name. Unless you can give me an advantage, unless you can give me a real reason why you'd want to hold the physical certificate, I don't see any advantage to doing it, because you lose liquidity. Yen versus US, as implicitly by your words, I suppose Japanese authorities do not alert every time that they will intervene in forex markets. No, they do not, and they don't even comment. There was a belief on Monday morning, early, that they intervened because the currency moved very significantly, very fast. I think it was like 7:30 in the morning on Monday, at least, Toronto time. Later in the day, there was through the news feed, I saw a headline that the Ministry of Finance in Japan offers no comment. That they were asked and they just didn't comment on it at all. So you do have to go to their website and get their monthly report. That's it. How do you detect these movements? Well, you don't really detect them. You know that they're willing to do it. And if you see a big move in the currency and you see no other moves in any other currency going on, and there's no news and nothing happening, you look at the US Treasury market, nothing really much going on there. You have to say, well, that looks very specific, especially if it's sustained in one direction for a period of time, not just a spike on a 5-minute bar and then down we go, and then the next bars are lower. You need a spike, and then these spikes on these bars just keep going in the same direction. And that's it. Price or volume alerts. Well, the volume in Forex is notional, because there is no notion of shares, right? So it's notional. So you have to have the ability to track notional amounts. Some brokers won't be able to get that done for you, so you only have price movement, not volume. You should be able to get volume, but because there's no shares, there's no unit, it's notional, because $1 is $1, right? So a million is a million. That is $1 million that transacted. That's the volume. So it's slightly different than you would expect. You don't really know. It's very rare that they'll tell you. I remember once in 2012, or it was 2011, I forget what year it was in, where they did intervene because the yen was under 80, and they had a coordinated intervention with other central banks, and they did announce that they were going to intervene at 9 p.m. on a Thursday evening, and they did, because they wanted the rest of the market to help them out as well. Well, right now what they're trying to do is punish short sellers. They're trying to make you terrified to short the yen by stepping in every now and then and crushing you by moving the yen 3 or 4 yen at a time. for no other reason than to stop you out and to hand you at losses again and again and again and again, to the point where the short sellers say it's not even worth it, because they'll just show up in the middle of nowhere and they'll crush you. And you got to play with tight stops. And if you play with tight stops, you'll get knocked out more often than you want to. And it ends up just being a loser's game, because you can't get on the winning side of a trade. Because if you are on the winning side of a trade for any period of time, they could step in and just wipe you out in no time. So, it's that's really what they're trying to do now, is just tire out the short sellers to say, stay away or we'll punish you. But there is no, unless they announce it, there's no possible way to know it. But announcing it eliminates the punishment part of it, because short sellers would say, well, I'll get long and I'll make money off them, and when they're done, I'll just go short again and make them do it again. Okay, if we expect real GDP to drive markets higher over the intermediate term and long term, we need consumption, investment, government spending, and exports, imports to be net positive. In my mind, consumption is challenged, particularly as Bloomberg estimates a 100% chance of a recession in the next 12 months. But you said intermediate and long term. This is short term. And the wealth effect from equity and property prices affecting spending. Investment is challenged from higher rates now. Government spending will need to be at current high rates. Government spending will need to be at current high rates. Why does government spending need to be at current high rates? With inflation and wage inflation especially, governments have never had more money coming in. They're issuing less debt, and the budget deficit's a lot smaller than what they projected, purely because of the increase in the taxes. Inflation pushes up prices, while sales taxes are on the higher prices, even if it's the same 6% sales tax. If you're in a particular tax bracket, and you get a raise mostly because of inflation, well, if you pay 30% of your income, well, you pay 30% of your raise in tax. So lots of money is coming in. So I'm not sure that this is true. At odds with tightening monetary policy. Governments want to spend more. I can get on board with that, but they will not need to. Where are we getting incrementally higher real GDP, which would trigger a bottom in a new bull market? I'm not seeing it. Who said we should be seeing it, though? I don't know that anybody is calling for significant increases in real GDP over the next 12 months. I mean, you did say intermediate and long term. Intermediate, the 5 to 10 years, long term 10 plus. And then you jump to 12 months, which is the next couple of quarters, really. So I guess on this one, I would say no one is expecting real GDP to skyrocket in the next 12 months. No one. So I don't know how to answer that one. Why do options expiration dates like Friday generate huge volume levels on index individual stock charts? Is because market makers exist. So when you buy options, there's a bid and an ask. Somebody has to post a bid and an ask, and it's usually a market maker. If there's nobody else willing to trade, a market maker has to post a bid and an ask. So let's say that they sell, you buy calls on the ask. So you're long calls. Well, they're short calls. They're short calls, so they have negative exposure, and let's say the call had a delta of 50, they will then buy 50 shares in the market to have 0, and they make their money on the spread between these two, the bid and the ask, because they're sitting on both sides. So they buy 50 shares. If somebody buys a put and they sell a put, and the put has a 50 of delta, then they sell these 50 shares and they have a call and they have a put, and they're flat. They try to be delta neutral and gamma neutral as much as possible. But as expiration date approaches, especially if the price is around a strike price, what happens is the deltas on these calls and puts oscillate very quickly from +1 to 0 to +1 to 0. Which means in that particular day, if there's a fight around a strike price, and the calls are going up in value, they have to step in the market and sell and sell and sell and sell more shares, which will push the price back down to the strike price. If it goes below, then for the puts, they have to step in and buy and buy and buy and buy. And so you get these fights around these strike prices with huge volume because the market makers buying and selling, buying and selling, buying and selling. So that volume during the day, a lot of it is market maker volume that you can read nothing into. They're not doing it for any fundamental reason. They're not doing it for any technical reason. It is purely an operational reason, and that's all. A market maker's best outcome is that the majority of people who bought calls, the majority of the open interest that exists that they're holding, decides to close their position out in the week approaching expiration, so that by the time they get in on Friday, very few people have that open interest is so small that they don't have to do very much. That's usually not the case on the index. So you get a lot of prices that stick around a particular strike price only because the buying and selling that the market maker has to do every time. So if you have puts and calls at a strike of 35 and the stock goes to 35.05, well then you got to do something. You got to start selling some stock. If it goes to 34.95, well then you got to start buying some stock, because on that last day, gamma hedging is rapid and fast, and you have to keep moving. So it creates volume where there is no fundamental or technical reason for the volume. Warren Buffett won events against a hedge fund manager. An index fund outperforms any investment manager in an after-fee basis over a decade. I'm not sure that is exactly what he would have said. He would have lost that bet. He would have lost that bet instantly. If this is true, why should we bother about active management? Because if he made that bet with me, all I would have to do is find one investment manager who beat the index on an after-fee basis, and I would say, Warren, look at yourself. You did. You're one. Pay up. So I don't think that he meant it that way. I think what he said, or what the bet probably was, is that any manager who is attempting to beat an index fund, in other words, their benchmark is the index. So let's say that my benchmark is SPY. That's my policy benchmark. That means I have all the stocks in the SPY to choose from. And then there's an ETF for SPY that will return exactly what it returns, or even better, if we're talking about an index fund, there's just a paper portfolio of all the stocks and that's it. Well, if my benchmark is SPY, that is my investment universe, SPY. So I must overweight some stocks, I must equal weight some stocks, and I must underweight some stocks, and I must do this in such a way that over a 10-year period, I do better than what you would have done by just holding everything equal weight. Brutally difficult to do. Brutally difficult to do. But Warren Buffett doesn't have a benchmark. If I'm a hedge fund manager and I don't have a benchmark, I can continually beat the market again and again and again and again. And it's not difficult to beat the market if you can invest outside the benchmark. So for example, on SPY, if I can use options, over a 10-year period, I could probably beat the benchmark. However, somebody would come along that's doing performance evaluation and say, well, wait a minute here. You're using securities that lie outside the benchmark, so that you're not really. This is not a passive. The SPY doesn't quite represent your true benchmark. So your true benchmark you did not beat. You're beating some policy benchmark that is not your true benchmark. So if he meant an index fund outperforms any investment manager, then he would have lost that bet because he has, right? So he probably meant something very specific, that if you are investing in an active manager whose benchmark is the Russell 2000, that over a 10-year period, you probably would have done better just investing in the Russell 2000. Yeah, and he's probably right, because it is brutally difficult to do unless you can invest outside of your benchmark. But if you could, then that's not your benchmark anymore. So the point I think overall he's making is that no matter what you're doing, we can devise a passive benchmark that tracks what you're doing, and you'll never outperform that. Possibly he's right on that. Okay, the fact that Meldrum is the Bank of Canada governor. It's kind of like like Jerome Powell in the U.S. He's our version in Canada. Only did 0.5 today. Listen to the part of the conference where he clearly stating that we are at the end of the hiking cycle, and defending 0.5 is already a sizable increase. How surprised is this rise? What are your thoughts? Yeah, everyone thought he would go 0.75, but there seems to be a general consensus in Canada that we are going to enter a recession next year, which means that's going to do most of the heavy lifting anyway. So if the Bank of Canada is seeing the same thing, saying, yeah, it is highly likely that we're going to enter a recession, what would 0.75 do, right? It would just hurt a lot of the mortgage holders who have resets coming up. So go 0.5, which makes the point. It is sizable. The recession will take care of inflation. I kind of think the Fed is probably in the same boat, that if they go further, they will cause the recession that cures inflation. So, getting to 5 might not be necessary. Getting to 4.25, 4.5 might be enough to cause the recession and let the recession take care of it. So it is surprising. I thought 0.75 would happen, and only 0.5. And it is still pleasing to see the Canadian dollar stronger today, even on that news. Regarding duration, if duration measures the sensitivity of the price to a change in the yield in my bond, and yields are related to the respective Treasury benchmark, and Treasuries are related to the Fed funds rate, well, when we say they're related, there is no mathematical formula that relates them. They are influenced. Let's change that word to, they are influenced by the Fed funds rate. The Fed funds rate is the overnight rate. You don't have to say shorter durations. The Fed funds rate is overnight. It is not part of the yield curve. That means that instantly when the Fed raises the funds rate, my bond drops in price? Not really. If the overnight rate changes, but none of the par rates change, in other words, the market says, we knew 50 was coming, we're already priced for 50, and they raise rates 50, the par curve might go, and not change at all, in which case your bond doesn't change in price. Or this implied raise are already priced in the bond's price. It may already be priced in, it may not be priced in, and what moves the yield of my bond is when people change their minds about the implied raise. Well, what moves the yield of your bond is supply and demand, because it's market determined. The Fed does not, I shouldn't say they don't get involved in that. They do if they're a quantitative, if they're buying bonds in the open market, they will drive down yields, but for the most part it's market determined. My bond change price due to this factor, or the change in price driven by market expectations. It's, mostly market reaction to information. Markets expect things to happen, and they'll price those things in. So being that there's an expectation the Fed will go 75 basis points next week, that's probably already priced in for the most part to the curve. And then there's day-to-day information exchange, things are getting better, things are getting worse. And then if they do raise 75, the market has priced all that in, and maybe bonds don't move at all that day. Here's a question about GDP in the market. With people now having fewer kids and at a later stage in life, do you think about a possible sustained recession in the long-term future? Don't know what the lack of kids have to do with that. If I make $100,000 a year, I'll spend $100,000 a year, but my kids will have to get some of that $100,000. But if I don't have kids, I get to spend all of that on me. So it's spending that matters. It's the aggregate income in the economy that matters. What matters more is not so much fewer kids. What matters more is the age of a population. If you have an aging population, aging people spend less. They have a lower propensity to consume. So if you have 10 65-year-olds all making 100,000 or 10 30-year-olds all making 100,000, the 30-year-olds will spend more of that 100,000 than the 65-year-olds, which is better for the economy. But a lower population growth rate can be met with a higher immigration rate. Do you ever think of a possible sustained recession in the long-term future, 20 or 30 years? At some point, world population will top out and will start to contract. At that point, I think we will be looking for new definitions of growth. And I think the best definition of growth is GDP per capita. Because if you have a shrinking population, you could still have everybody in that population doing better, such that GDP per person is increasing, even though GDP aggregate is dropping because the population is dropping, per person is increasing. So, I don't know that, like the universe that starts with a big bang and ends with a big crunch or the big chill. I don't know that an economy has to end that way either. It can continue to grow per capita. If you are, the scenario you're describing here is Japan. Japan is unfortunately averse to immigration. So that's why it has the, dilemma it has now. As you mentioned, the participation rate and the population decrease. The only way GDP could increase if we assume continued increasing productivity in workers. That is true. You get productivity in workers, you can get, it's if you have productivity increasing faster than the workforce is decreasing, you can have increasing GDP to a point, because if the participation rate drops enough, you're not going to have enough people making money to buy all the things that increased productivity could create, which means you better have a heavy export market, because you're not going to have domestic consumption. There's another problem with Japan as well, right? Since GDP is the main driver in market returns, yep. And other factors being mean reverting in the long term, do you think equity markets could reach a peak and remain there indefinitely? No, not really, because companies come and go, and those that go leave the index and new ones come in. So the index is always, you could not, I wouldn't quite call it new economy, but the index is always current economy. So you don't have, if you go back to the 1970s and you look at some of the names that were in the S&P, some of those names have just completely disappeared altogether and are gone. Same with the 90s. Go back to the 90s, look at some of the names there. The turnover is quite significant. So because the market itself is always the current market, no, I don't think so. It's a problem when population starts to shrink globally. I think that's going to be an issue at that point in time, but I won't be around, so don't really care. Okay, I was going to ignore this comment here, but I thought I'd put it up here just to make a point. Not sure whether you are into the auto loan market. There are gather attention that the auto loan may be the next black swan, and it may force the Fed to lower interests to save the market, said by the ARC lady. And that's as far as I got, and I said, oh, well, ignore that then. I've listened to her a couple of times on YouTube. She does these weekly things, and some things that she says, I wonder, where she got her training or what her motivation is. It sounds more like she wants you to believe what she's saying because it serves a position that she has, as opposed to it being intelligently articulate. So I don't listen to this one. You would be wise not to listen to this one either. These two are related. Two questions about home builders. The bearishness for both sectors can be justified if we're only speaking about valuations, not fundamentals. Um, well, for home builders, there are fundamental reasons why we would be bearish. There are labor constraints. There are material constraints. There was significant hike in material cost. There was a sawmill that was offline for how long? There is an undercapacity of sawmills to produce lumber in the U.S. The shortage of labor, shortage of skilled workers. So there is, for a home builder, you cannot build as many homes as you would like to build. And with interest rates going up, there goes your traffic flow. There goes the demand. It also becomes more expensive for you to commit capital to build out a lot. So you'll buy an undeveloped lot. Let's say it's 25 acres. It might cost you $4 or $5 million just to service that lot before you can even get it ready to start building homes on it. So there's a whole bunch of costs, and that may take 1.5 to 2 years depending on the permitting process. Well, now the cost of capital for home builders is super high, so all of that slows down their activity. But for REITs, what was going on is you have a present value for a REIT. You have net operating income that is growing at a certain rate per year, discounted at some discount rate. Well, with interest rates going up, the R component in your denominator has been going up. But your G component is going up as well. It's just that the adjustment for rates, R was going up much faster than G. So as R starts doing this and leveling off, G will still continue to grow. You'll start to see that the numerator becomes bigger faster than the denominator becomes bigger. So I don't know that there was much more in terms of REITs other than the discount rate. In other words, cap rates were rising only because R is growing faster than G. That's all. Both sectors could simply be overvalued. Well, I thought REITs were overvalued for a while before they had their sell-off at the beginning of the year. You had apartment REITs with cap rates, some of them 3.5, 4%. Those are unattractive cap rates. Even if you were looking at units that were not in major markets. Same with office and industrial. The cap rates were ridiculously low on them, to the point of, look, you're buying into REITs that have a 2.8% dividend yield. No, thank you, because there's no tax break on that dividend yield. It's pure income. That's going from a period of time when REITs, before this recent period, REITs were always good for anywhere from a 6 to a 9% dividend yield. That was considered respectable because they weren't tax advantaged, so they were overvalued. But I think it's overdone on the apartment REITs. I think that was overdone by a long shot, because rents just keep going up. Wall Street Journal had an article this week about household formation rebundling. Renters moving back in with their parents, getting roommates because rents are too high. So the notion that people have to live somewhere is true, but this may not support multifamily demand. Do you believe that your Resi REIT thesis still holds in light of this? Yep, I do, because we don't have job losses. We still have job gains. When you start seeing job losses along with people moving back into their parents, that means they truly cannot pay the rent. As opposed to just choosing not to pay the rent, they truly cannot pay the rent. So if you have that kind of trend along with job losses, then that is, that's a little tricky to navigate. But we have job gains. So yeah, some people are choosing to live with their parents. I don't know that there's ever been a time where I wasn't aware of somebody moving back in with their parents. I mean, no matter what's going on in the economy, there are people moving back in with their parents, no matter what's going on. So, whether it's through necessity or just laziness, that I don't want to pay for rent, and I don't want to do my own laundry, and I don't want to go shopping. I want mom to do it, and I want I don't know. That kind of story is nothing new. I've heard that. I think in almost every market I've heard that being brought out. There are certain things you hear all the time. You know, whenever an analyst comes on justifying why the market goes higher, the same things are trotted out every time. There's a lot of money on the sidelines. Hedge funds are underperforming their benchmarks. People are too bearish. It's the same reasons no matter what's going on in the market. I hear that same story. I've heard this before. I think I've heard this sort of thing. This story shows up every now and then in almost every market we're in, because it is considered one of those a sign of the times story. You know, I don't ascribe too much to that. I look at the occupancy rates in the apartment REITs that I currently hold. Never been higher. They've never been higher. When I start seeing those occupancy rates drop, or when I start seeing apartment turnovers increase. Right now, apartment turnover is super low, because if you're in a unit and you extend for another year, there's a limit to how much your rent can raise. But if you leave that unit, that's great for the apartment building, because they can then adjust the rent up to market rates and get a new person in there. So when rents are going up, you want to see people move out, because you can adjust those rents back up to market rates very quickly. But when rents go up, people don't move out. They stay put. So occupancy rates are super high. Apartment turnovers are super low. They're both leading indicators. None of them are turning over. None of them are turning over. So, you know. Let's see. The REIT comment about not being able to be bearish on housing and bearish on residential REIT doesn't quite land well with me, though. I suppose the academic thought makes some sense. People need a place to live, and fewer buyers inevitably result in more renters. But in practice, residential REITs have been hit in every housing market downturn, and then typically run up along with home prices. With this historical correlation, what is substantially different about this setup? And I think somebody had answered it. What is different about this particular setup is we are in a structural housing shortage right now, and we will be in a structural housing shortage probably for the next 10 years. Which is why I'm extremely interested in the home builders right now. I've made no secret about that over the last couple of months. I have been building positions in different home builders. I like DHI the best. I have exposure to the XHB, and I do straddles on the XHB each month, and I have no problem continuing to collect on that, because you need more housing, plain and simple. Yesterday, I shared a story on Twitter from our Ontario government here in Canada, our Conservative government, that they are removing certain fees for developers to try to spur housing demand, housing supply. They're trying to fix the supply side. They recognize very clearly that we have a housing shortage in Ontario. So they're doing what they can to say, well, how do we increase supply? If we're going to fix housing affordability, we have to fix supply. Period. You can't just tell buyers to stay home or to rent, because there's always a cost to getting that done. You got to fix supply. Until the U.S. government finds a way to completely flood the market with houses, I'm bullish on the housing sector long term. And you buy when there's absolutely no reason to buy, when everybody is downgrading it, including an analyst with the best porn name ever, Buck Horn. Buck Horn from Raymond James downgrade. When you see something like that going on, you got to say, okay, well, I'm in. So the difference this time is you have a shortage of options. So housing is becoming more unaffordable. Where are you going to go? Typically, rents compete with houses. So you can rent, or you could say, listen, what I pay in rent is equivalent to a mortgage payment. When that is the case, then there is a move over to housing if you can find a house. I know somebody here in St. Catharines and somebody in Mississauga they're cash buyers. They don't need a bank behind them. They don't need a bank. Full cash buyers who've been looking since April to buy a house. And they keep saying the same thing to me. Nobody wants to sell their house. There's no supply. There's nothing to buy. There's just nothing to buy. And that's it. If there's nothing to buy, they stay exactly where they are. So that's the big thing this time. that we didn't have in 2006, 2007. You had overbuilding in front of that. Here we have no overbuilding. We've had underbuilding 2011, 12, 13, 14, 15. You had underbuilding for that period of time, but household formation continues on every year. So if you're building like this, right, well, here's a deficit, here's a deficit, here's a deficit, here's a deficit. So when you get into surplus over here with your house building, you've got this backlog of deficit that you still have to work off. You're looking at 10 years. 10 years of increased, and I mean increased home building to balance this market. Well, if you look at the pace of new home construction, it is about 1 million units per year below where it needs to be. There's no place to go. I guess I could bring a third one in, say, well, you know, if I'm bearish on housing and I'm bearish on residential REITs, I got to go long tents. I got to find a tent maker and go long tents, because that's the only place left, right? We're going to end it here. I'm looking at the time and I'm looking at how many I've done, and there's just too many to get to, so I haven't got to your question. You can ask it again at some other point. But next week, just to manage the number of questions, I really am going to limit it to those that have the little red icon beside it. The red icon tells me that you are a subscriber. If your question doesn't have a red icon beside, only I can see these red icons, by the way. As the owner of the channel, you won't see the red icons. I can see them, then I know that you're subscribed. I'm gonna have to just answer those, because there's a lot of them. I enjoy doing this, but there's just a lot of them. Okay, that's it.